It's in market conditions like right now, where the market's down 20+%, that pre-retirees and retirees start to get really concerned about their portfolio. So if you're 2 years away from retirement, which means you might be 2 years away from actually needing to live on your portfolio, or you're already in retirement taking distributions, you could be really concerned because you see the market erode your portfolio, but also your lifestyle, your activities, the enjoyment that you have every single day, this time frame that you've been dreaming about for the last 40 years when you didn't have to work and now you have time and energy to do some of the things that you want to do outside of work, could be seriously impacted by the market, something that you really can't control. This is where you start to get really concerned. See, when you were 40 years old and the market was down 20, 30%, your portfolio was down 20 to 30%, it was just your portfolio. But now you're dependent, or soon will be dependent upon your portfolio. It's your lifestyle that could potentially be impacted. And this is the environment that many of you are facing right now. Just as an example to kind of illustrate the impact a down market and you taking distributions from your portfolio at the same time can have, let's say you're in year one of retirement. You have a $500,000 portfolio. Your portfolio is down 20%. Now you have subscribed to the old 4% withdrawal rule, which means you can live on 4% of your portfolio, starting retirement portfolio, which again in this case is $500,000, and take 4% out each and every year and have a high level of confidence you're not going to run out of money before you run out of time. That's the old 4% withdrawal rule. So you subscribe to that. The portfolio is down because of the market by 20%, which means your $500,000 portfolio has eroded to $400,000, but you were still planning on spending 4% of the $500,000, which is $20,000. So the market has eroded $100,000. You need to live on $20,000. You're year one into retirement. Your $500,000 lifestyle portfolio is now only $380,000. That's just year one. What are you thinking? You need to have this money last the rest of your life, potentially 20 to 30 years. You're concerned. You're worried. And that's just year one. What happens if we go through another down market in year two? This reminds me a lot of the year 2000, 2001, 2002, where 3 straight years the market was down. Many of you probably know of people who had to come out of retirement, whether it was early 2000s or even in 2008, because this happened to their portfolio. Many of you know people who had to postpone their retirement during those same time frames because this happened to their portfolio. And you're starting to wonder, is this going to happen to you? Do you have to come out of retirement to preserve your portfolio, wait for the market to come back up, or do you have to push out your retirement, delay your retirement? Nobody can control the markets. You can't control the markets. We can't control the markets. But what you can do is control the income plan to make sure you get the lifestyle that you have always dreamt of. Here's one strategy. It's called the bucketed strategy, where you have 3 different buckets. They're all designed a little bit differently with very specific goals. The first bucket, this is your income bucket. I call it the lifestyle bucket. This is what is going to enable you to do all the things that you want to do. You're going to be able to take the grandkids on trips. You're going to be able to RV around the country. Maybe you want to winter in Florida for 2 to 6 months out of the year. This is all your lifestyle ambitions in retirement. You're going to take the $20,000, going back to the $500,000 4% example, $20,000 you need from the lifestyle bucket is going to come from here. This money is going to be invested extremely conservatively. You're not going to have any stocks in this bucket. In this environment, you probably won't even have any bonds unless they're very, very short term. You're going to have cash equivalents, money we know is liquid and it's safe. It's going to be there when you need it for your lifestyle. The second bucket is your midterm bucket, which is going to be invested with a little bit more risk. In this environment, you might have some stocks sprinkled within there, a little bit of bonds, maybe some midterm bonds, and cash equivalents. You want to make sure it's truly diversified. Your goals with this bucket is to grow it a little bit, beat taxation, beat inflation, and it's going to, the earnings, the interest is going to spill over into the income bucket to continuously replenish the money you're taking out from your lifestyle, for your lifestyle. Then you have the third bucket. This is money you're not going to need for at least 10 years. You're going to take more risk with this bucket. This is your growth bucket, so you're going to have a higher concentration of stocks, bonds. You also want to make sure it is truly diversified. the interest, the dividends, the earnings you make from this long-term bucket, this growth bucket, is going to spill over into the midterm bucket to replenish the money that's coming from the midterm bucket to replenish your lifestyle bucket. So it's very much this cascading waterfall effect to make sure each one of these buckets is doing exactly what it needs to do, with the primary goal of filling up, keeping filled up your lifestyle bucket. So you don't have to sacrifice your dreams, your lifestyle dreams, your retirement dreams, regardless of what happens with the market. The markets are going to go up. The markets are going to go down. They always have, they always will. On average, we go through recessions every 5 to 6 years. We should not be surprised by that. We should be poised to make sure that our investment plan is recession resistant and our income plan works with our investment plan to make sure we can always have the lifestyle that we want. Subscribe today for much more. Also take advantage of the complimentary 15-minute retirement checkup phone call.